Have you ever lost money because you trusted an investment tip that seemed too good to be true? In 2026, the world of investing has drastically changed. With technology moving faster than ever, more people are falling for hidden pitfalls that end up costing them thousands. From the rise of AI-driven portfolio management to the explosion of digital assets, it's easy to make mistakes that can drain your savings before you even realize what's happening. But what if you could avoid these costly errors? In this video, I'll walk you through the top 8 investment mistakes that people are making today and how you can protect yourself from them. 1. AI hallucination, asset allocation. Investing with AI is becoming the new norm in 2026. Platforms powered by artificial intelligence promise to help you build a perfect portfolio with minimal effort. The problem? AI systems are still not perfect, and they can often provide hallucinated advice, suggesting assets that don't even exist or misinterpreting real-time market conditions. For instance, you might trust an AI to suggest the next big asset to buy, but it may guide you towards a ghost token or an asset with no actual backing. This is a huge risk, as you could end up investing in something that has no intrinsic value. These types of errors occur because AI models are trained on vast datasets and in some cases, may fail to distinguish legitimate assets from fraudulent or obscure ones. The cost of this mistake is steep. By following these misinformed recommendations, you could find yourself with phantom investments that lose value quickly, leaving you with significant losses. The fix here is to use AI for what it does best, analyzing data, but always verify the final decision with a regulated brokerage or a human advisor before pulling the trigger. AI should act as a tool to enhance your strategy, not as the sole decision maker. In the end, AI should be a tool, not your entire strategy. By combining AI's analytical power with human oversight, you can significantly reduce the risks associated with hallucinated advice while leveraging the advantages of automated portfolio management. 2. Over-diversification in micro-tokens. With the rise of tokenization, it's now possible to invest in just about anything: art, wine, carbon credits, and even more obscure assets. The idea is appealing, especially when you can start with as little as $1. However, one of the biggest mistakes you can make is spreading yourself too thin across hundreds or even thousands of these micro-assets. Over-diversification is a classic error where you invest small amounts in an overwhelming number of tiny assets, 500 different micro-tokens, for instance. While the low fees on these platforms may seem attractive, the reality is that you'll end up with a mountain of assets that are too small to provide meaningful returns. Moreover, the management overhead of keeping track of all these investments means you're paying more attention to fees than actual profits. Instead of jumping into every micro-token available, it's better to focus on 3 to 5 high-conviction alternative assets that align with your investment strategy. This approach allows you to build real wealth with focused, meaningful investments, rather than getting lost in a sea of tiny, insignificant holdings. 3. Ignoring protocol risk for high yield. Many investors are drawn to high-yield opportunities in digital finance, especially with assets like stablecoins or digital dollar accounts. Platforms promise eye-popping returns, often in the range of 10% to 15%. But what many people overlook is the protocol risk that comes with these high-yield investments. The issue arises when you invest in platforms or smart contracts without fully understanding the underlying technology. If the platform's smart contract fails or the protocol behind the interest generation crashes, you could lose not just your interest but your principal as well. This is a huge risk in the world of decentralized finance. The fix here is simple. Only use institutional-grade platforms with properly audited reserves and insurance backing. If the platform isn't regulated or doesn't offer these protections, it's not worth the risk, no matter how attractive the yield looks. 4. Reactive generative engine trading. In 2026, the pace at which news travels has drastically accelerated, especially with the help of generative AI. A piece of AI-generated content can spark reactions from traders and algorithms in mere seconds, often causing flash crashes in the market. A sudden, fake headline could send stock prices plummeting, causing investors to panic sell in response. The problem with this approach is that it often leads to emotional, knee-jerk reactions. A short-term dip could be the result of a misinterpreted headline or an AI-driven story, but if you panic sell, you're locking in losses that might otherwise be recoverable. The fix is to avoid reacting to every news cycle. Instead, set up trailing stop losses for your long-term core holdings, and resist the urge to jump in and out of investments based on every market fluctuation. This strategy allows you to weather the storms without selling during a dip, especially when the news is often driven by artificial intelligence and not actual market conditions. 5. The copy trade trap. Social trading platforms have made it easier than ever to copy the portfolios of top investors. You can now auto-sync your investments with so-called alpha creators, the top-performing investors in the market. Sounds like a great shortcut to wealth, right? Unfortunately, many people fall into the copy trade trap by syncing their portfolios with someone whose risk tolerance is vastly different from theirs. If you're following a pro who uses 10x leverage and engages in high-risk trading, you might find yourself overexposed to volatility, especially during a market correction. The cost of this mistake is high. If a market correction hits, you could be liquidated because your portfolio was too heavily leveraged. The fix is simple. Only copy trade with a small percentage of your total portfolio, e.g. 5%. This way, even if the copy trading strategy doesn't work out, your main portfolio remains unaffected. 6. Tax blindness on atomic trades. In today's world, trading is faster than ever, thanks to atomic trading apps that allow for hundreds of tiny, automated microtrades throughout the day. While this can be a great way to maximize gains, it often leads to a hidden issue: tax blindness. Each time you make a small profit on a microtrade, it's a taxable event, and many investors fail to realize that until tax season rolls around. These constant, tiny gains can add up quickly, leading to a hefty tax bill that wipes out a good chunk of your profits. The fix here is to use tax-advantaged accounts or automated platforms that offer tax loss harvesting and integrated tax reporting. This way, you can keep track of your tax obligations and avoid the unpleasant surprise of a massive capital gains tax come April. 7. Neglecting digital estate security. As more wealth moves into digital wallets and tokenized platforms, many investors overlook the importance of digital estate security. Without the proper safeguards, your digital assets could be lost forever if something goes wrong. For example, losing a private key or having a two-factor authentication, 2FA, device malfunction without a backup can result in the permanent loss of your assets. The cost here is staggering. Thousands, or even millions, of dollars could be lost due to inadequate security measures. The fix is to use multi-signature, multi-sig, wallets or work with regulated custodians that offer inheritance features, ensuring that your digital estate is secure and accessible by your loved ones in case of an emergency. 8. Chasing AI infrastructure at the peak. Everyone is jumping on the AI bandwagon, especially when it comes to owning the shovels of the AI gold rush, the companies building chips, data centers, and energy infrastructure. While these stocks have seen impressive growth, the mistake comes when people buy into these stocks after they've already tripled in value. The cost of entering the market late is that you might find yourself investing in a crowded trade just before the market corrects and realizes the projected growth was already priced in. The fix is to look beyond the obvious players and focus on secondary AI winners, companies using AI to disrupt traditional industries like logistics or agriculture, which still have significant growth potential but aren't as overvalued. And there you have it, the 8 investment mistakes that could cost you thousands if you're not careful. From falling for AI-generated investment tips to neglecting your digital estate security, these pitfalls are all too easy to fall into in today's fast-paced financial landscape. But with the right strategies in place, you can protect yourself and make smarter investment decisions. If you found this video helpful, make sure to like it, share it with anyone who might benefit, and subscribe to the channel for more tips on navigating the ever-changing world of investing. Thanks for watching, and I'll see you in the next one.